Good Monday morning, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with myself, Will McBride, and the main man, all the way from Philadelphia, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to help to provide you with advice, give you guidance. So there's the disclaimer.
Excellent.
And let me share my screen. One thing I want to mention is we do have a webinar tomorrow with Interactive Brokers. We'll be talking about earnings moves, and I will be showing a new feature tomorrow on that webinar that doesn't exist today. So we're aiming to publish that feature out overnight tonight. So tomorrow will be the first day it'll be available, and I'll talk about it for the first time tomorrow on that webinar on Interactive Brokers. That is going to be at 2 o'clock. Will, is that correct?
It's 2 o'clock tomorrow.
Yeah, and you have to register with Interactive Brokers, so they're hosting it. It's not something that we're doing like usually when we put it on YouTube live. It's going to be within Interactive Brokers, so you do have to register to see it. I think you will be able to see replays if you register, but it's not something that will be on YouTube.
You still, even to see the replays, though, you have to register. I think you said that, but I'll just reiterate that.
Yeah, you'll have to register, yeah.
And I'm going to put that link to the registration in the chat, so anyone can go over now and register for that.
Right, and the idea behind this new tool is to kind of see if we could make it easier and simplify the analysis of earnings moves, so you could kind of prepare ahead of time. If you do trade earnings and you're interested in, the distribution of returns around earnings and how the stock usually or tended to perform, what did the options tend to do around earnings? If you're interested in that, that's what we'll be talking about tomorrow at 2 o'clock.
Awesome.
Today, if you guys have any questions, please put those questions on the live chat on YouTube. Will's watching them. He'll read it back to me. If you want to come on a show and ask your question live and direct, we also put out a link to Zoom. When you click on that link, it takes you over to Zoom. Once you're in Zoom, there's a button, raise your hand. You don't have to turn on your video camera, but everybody will be able to hear you live. You could ask your question, direct us to what you're looking at, and we'll try to answer those questions. While we're waiting for any questions to queue up, what I'll do is take a look at the pre-market report, see what's trading in pre-market hours, maybe navigate to one of the tools we talked about last week, kind of continue demonstrate the tool. And if questions come in, will stop me and I'll take them.
Perfect.
Okay, so right now we're on the pre-market report, and these are stocks trading in the pre-market hours. We have the most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, I see 99 stocks made our percentage gainers list, 24 on our percentage decliners. So right now, from that perspective, we're setting up for a more bullish bias at the open. I'm going to filter out this list to just S&P 500 stocks. So we want to take out from this list any low cap stocks, ETFs, leverage products, preferreds, closed-end funds, rights, units, all those. Let's take them out just to focus on S&P 500 stocks, see what's going on there. And to do that, I'm going to use this filter here in ETF. I'm going to drop it down, and you could see in that list, I have a bunch of different ETFs. by selecting one of the ETFs, I'm going to filter out the list by the holdings in that ETF. So let's do SPY, which is the S&P 500 ETF. And here I see 16 stocks made our percentage gainers list, 3 on the decliners. So from this perspective, it looks also like a more bullish bias at the open. And what is like we're up 0.5% or something in the futures right now. Couple things going on right now. I think that the dollar is weakening, right? A little bit. The dollar is weakening. And there was some progress actually over the weekend. I don't know if you've been reading it with the war in Ukraine and Russia. So Ukraine apparently made huge gains and recaptured over like, I don't know, 1,000 square kilometers or miles, something huge. Over the weekend, I've been seeing it, coming through, reading about it. That could also be a reaction to that Russia has been backing away, retreating. Ukraine's been making a lot of gains there. Maybe that's also playing into some of the gains we're seeing in the pre-market so far today. Have you heard about this? Well,
I did read a little piece this morning, actually said that a lot of Russian military gear has been left in the retreat, which is, a little shocking.
So they're really retreating. Yeah, if they're leaving intact, right? It's not like they basically like just ran away, left their gear there, which is pretty embarrassing for an army to retreat. Not because you'd think they would try to destroy it if they can't take it with them, but they just kind of left it there intact, meaning that they really just took off. So I think part of that is playing into it. I did read a little bit. I wanted to comment. I think last week we talked about margin calls in the energy, in the energy future, something like 1.5 trillion, right?
Yeah, it was mentioned right before the show started. I think it was last Tuesday, maybe, or Wednesday.
Yeah, and in the oil markets. So, and I read a little bit about it. If you guys have more insights, that would be great. If somebody is, an energy expert out there, wants to come on a show and explain it to us. But from the way I understand it is the following: that in Europe, a lot of energy companies, what they do is try to lock in future prices, right? By going into the futures market, locking in future prices, so they know ahead of time what they could hedging their risk, and they know ahead of time what they could sell it for in the future, and then they could figure out what their cost is today and kind of know their profit margins ahead of time, right? So the idea is, okay, if I produce it, if I invest in it today, I know how much I have to invest. I'm going to produce it in the future. It's going to cost me X amount. So if energy prices go up, I will lose on my short side in the futures, but I'll make it back on what I could sell it for. Or if everything goes down, yes, I have to sell it below my cost, but I was hedged with the future, so I'll make it back in the future. So does that make sense so far to everybody? So basically, that's how, a lot of commodity producers work before they go in and produce and manufacture. It takes time. They want to lock in that future price. And this basically smooths out the volatility in their margins. So here's the issue. The futures market and the spot market, whatever they have to produce, is on the books on one side, and the futures, whatever bet they made in the futures market, that's with their broker, right? So you go to a broker, you short a futures, and to short a futures, you have to put up money, right? And if the futures market is going up, you're losing on your short side, the broker requires you to put up more money, right? So they don't care, oh, well, I'm going to produce it and in the future I'm going to have it. You still have to make your margin call. So your collateral is the money that you put up. Futures go up, you lost money, you got to put up more capital. And and if it goes up a lot and you're losing a lot, you got to put up more capital. And if you can't meet your margin call, you have to buy that future back, right? So think of it as you shorted a stock. If it goes up, if you can't put up more money to make up for your losses and to cover the margin call, they're gonna cover it. They're gonna buy back the stock, and you're done. It's a margin call. So think of it this way: you have two things going on. One is that you're producing this energy with the expectation that you're going to sell it in the future, and then you have a hedge on. But the two of them don't sit inside your brokerage firm, right? So the broker can't. They don't care, like, what you're doing over there manufacturing. It doesn't offset your losses. So the other problem that can occur is the following: they have to come up with more cash to make up for their margins. But the problem that they might be facing, and this could be the crisis, like the Lehman Brothers catastrophe, is that there are talks within Europe to limit their profits, right? So basically they called it the windfall tax, or limit the prices that they could sell it. And that becomes a problem because the futures market doesn't care about that. So you produced a certain amount of oil prices are moving up around the world, you're hedged, but in Europe, you're under regulation. You can't sell it at that price. You got to sell it at price X, right? Or they'll regulate you, tax you, whatever, because now the government's stepping in trying to protect the consumers. And that could create a crisis, because the spread between where you hedged, you're losing, your profits are limited. So all of a sudden now you could be out of business. Does that make sense? So basically your hedge is no longer really a hedge. Does it? Hopefully that makes sense. So that is kind of the Lehman Brothers moment. And now they're starting to look at it, because I don't think the European Union wants any of that, right? Because they don't want these energy companies going out of business. That's just going to make problems worse. And that business model where they try to smooth out the volatility in their earnings, if they can't do that, that also creates a problem for them, because that impacts their decision making, their investments. How much risk are they taking on, because now they have much more fluctuation. They don't know where they're going to be, where the energy prices are going to be in the future, and that's why, based on the business model that they have in place, if there's a disruption in that could create a crisis where all of a sudden things go crazy. So that's one thing to keep an eye out. And I'm just mentioning it because we did kind of talk about it, where there's potentially $1.5 trillion in margin calls in Europe, but they are looking at it. I don't think they're going to let that worst case scenario happen. I think that the energy companies may even have an access to a government window to go and borrow money to make up for those margin calls, until they're able to, produce the actual product. So anyway, one thing to keep an eye out, because that was in the news. The other thing, I wanted to mention was right now the dollar kind of weakened a little bit, and people are looking closely at the inflation. And there are two kind of things right now in the inflation that I think the Fed and the Treasury are looking pretty closely. They mention the unemployment rate. And I think Janet Yellen mentioned this just recently over the weekend, that there are 2 job openings for every 1 person looking. And and I think that's important to watch, because that's going to drive interest rate policy. When you have that situation, it seems like it would be like a good indicator for the economy. Well, we have so many jobs, there's not enough people to fill it, right? So what's the problem there? That seems like that should be a good thing for the economy. And the problem they're looking at, not when we have low productivity and we're in an inflationary period. So that's why it's not good right now, not in the scenario that we're in, because it creates wage inflation across the board. So it would be okay if it was in one sector of the economy, like say car manufacturing. Hey, there are 2 jobs available for every one person looking, but it's in one sector. Well, the economy is supposed to work that way, because then we move our resources efficiently to where we need it, right? So, hey, too much, we overhired in one sector, another sector, there's not enough workers, the wages go up there, wages go down there, and then the economy works smoothly by moving resources efficiently. Right now, what we're seeing is across the board, right? Across the board, anywhere you look, every sector, every part of the economy, across the distribution, there's a shortage of labor, and that creates wage inflation. And in that kind of wage inflation, it's not only not good for inflation, it's not going to be good socially, because in that scenario, that the spread between the wealth gap starts to grow, right? So skilled labor, right? The skilled labor, the wage inflation will grow faster than the unskilled. And, just think of it as like, even if you raise the 10% across the board, somebody making 100,000 makes $10,000 more per year. Somebody making 40,000 makes $4,000 more per year. So on a notional basis, that person up the top can afford to buy much more raw goods than the other person. So that's going to create not only inflation that's could be entrenched, it's going to also widen that gap, wealth gap. And when I say entrenched, when we see inflation, like let's say on commodity prices, they're volatile, right? They could, oil prices could go up, they could come back down, food prices could go up, down, even the stock market could go up, down, but wages don't act that way. Wages don't go up and down month to month, right? Or usually you get hired, that's your annual salary, and you expect it to grow per year a certain percentage. That's just how it is. That's why it becomes entrenched, and it raises inflation expectations, right? That's what they're trying to calm down, future inflation expectations. And when we're talking about wage inflation, that is much more entrenched into the economy, right? Because it doesn't just move up and down, or if it moves way up, it doesn't just come back down like that. So that's another thing to keep an eye out for as far as inflation. They want to slow down. They want to balance it back into a good equilibrium. The amount of people looking for jobs versus the amount of jobs available. And And then the next thing, actually, should I just move on to a tool, Will, or just let me know if people have questions?
Keep going. We did have a question, but I mean, we only have 8 minutes.
Yeah.
Luis asked, I mean, this may be a whole show. I have where's Luis's question? Can you go over really quick how to utilize the put protection cost analysis section? Again, we only have like 7 minutes. And actually, just so you're aware, D, they did schedule that meeting. So we have a meeting right at 9:30. So
okay. All right. So let me just go a couple more minutes and then I'll go over, let's do the put protection tomorrow.
All right, we'll save
that
that
for
for tomorrow.
Specific question, yeah, about it. Yeah, email. I think I did see that email come through. Actually, sorry, I should have probably gone to it.
No, that's fine.
If you have a
This
specific
was a
question,
great discussion and something everyone should think about because it could have a
if
effect
you're
on
looking
where
at
the market moves, right?
Yeah, because right now I think there's a big focus on where interest rates could move to, and based on where you think the interest rates are going to move to, that's going to impact your valuations, your expectations for earnings growth, a lot of stuff, right? So that's what kind of I think is important to look at.
And it can also put risk on the financial institutions, right? Like
interest
rate create
sensitive.
Some sort of black swan event. You just mentioned one that we had discussed earlier with the energy hedging, but there was another article I read about in Britain. I guess most people have adjustable rate mortgages, and with the move in interest rates, people aren't going to be able to afford their mortgage payments, right? And it could lead to a whole series of potential defaults in the British bank. It's and who knows, right? That's what happens.
And one other thing that served as somewhat of a cushion for our inflation right now is that I'll show you. We started raising interest rates kind of earlier than some of the other developed countries. So here we are. Let me see. Am I on? So we're right here, United States. We're at 2.5% right now on our risk-free rate, right? And here's Europe at 1.25%. So you could see they're behind us right now. And why this is important is because if you look at the landscape around the world, reserve currencies, the European Union is probably next in line versus the US. Like I know, China probably has a bigger GDP than the European Union, but China's legal system is not as developed. Their financial system is not as developed. They're kind of not very transparent. So, if you go down to the next, currency around the world, it's probably the euro, right? After that, then you got maybe Japan, and Japan has actually their inflation's not as high as ours, but by Japan standards, I think they're used to like no inflation, right? Or deflation. They're at like 2.5%. So their interest rates are at 0. But the point I'm making here is that because we started earlier than the European Union and they dragged their feet, they're at 0.5%. You see that they just raised it to 1.25. The dollar strengthened. The dollar strengthening is good for people who hold dollars, right? Our purchasing power has gone up because the dollar goes up. So that served as a little bit of a cushion to our inflation, that not only are we raising interest rates, which fights inflation, but that the next currency that I believe is the next reserve right after the dollar has been dragging their feet. They're very late. They're kind of they're trying to follow us, but in a very delayed basis. So that's been good for us. I don't know if they start catching up. We might start seeing inflation, the dollar weakening, and that inflation starting to tick up, right? So those inflation numbers and they need to raise it, right? Because Europe is in worse, I think, in a worse situation than we are right now. And we might see some jumbo, hikes. We might see a jumbo hike here in the US, I think like 0.75%. It's coming up this month. Europe, we'll see what they're doing, but the fact that they're dragging their feet has been good for us. If they start catching up, we might start seeing those inflation numbers starting to head back up if the dollar weakens. We're right at 9:26. We do have that meeting at 9:30. Just a couple things I wanted to go over today. Basically,
great job, D. That was awesome. We'll get to Luis's question tomorrow about the put screener he was asking. I will try to copy and send that email over to you. Luis, you can also email us exact specifics of the question to support@MarketChameleon.com. And we'll try to run a whole show on it tomorrow. Great job, D. Thanks so much.
Yep. All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.
Trade in peace, chameleons. Have a great day. Bye, D.
Bye.